Hi, my name's Doug Lennick. I know you've been paying attention to the markets, which is why you're watching this. And I'm here to talk about the behavioral piece, if you will. Why do people do what they do with their money? And today we're going to spend a little bit of time kind of understanding us, me, you, from a behavioral perspective. In order to do that, I might draw on some concept associated with traditional finance, which of course is founded and grounded in modern portfolio theory and asset allocation and the like. I might spend a little bit of time on behavioral finance, which really is about the psychology of finance and the psychology of decision making. Psychology, of course, is the study of the mind and human behavior. And then I'll probably spend a little bit of time might even spend a little time on neuroscience. Neuroscience is the study of the brain, which of course might even already confuse you when I'm saying mind and brain. Important to realize the mind operates within the brain, but it isn't the brain. So we'll talk a little bit about that and understanding why we do what we do with our money. I'm going to group my remarks under three umbrellas. We're going to talk a little bit about what you can know, and quite frankly, what you should know. We'll also talk about what you can't know. And then finally, the big crescendo is we will talk about what can you do with what you know and don't know. So let's start with what you can know. You can actually know that financial decision making, and quite frequently, the financial markets themselves are driven by emotions, psychology, overconfidence in personal opinion, and literally how our brains actually work. You can know that. In order to understand that, I'm actually going to draw a picture which will help all of us see what the experience of reality really is for each of us as people. Reality, personal reality, is really a combination of three things. It's a combination of cognitive thought, it's a combination of emotion coupled with cognitive thought, and finally, our physiology. Our hearts are beating, we're breathing, I'm writing on the flip chart, and of course our actions. The interaction between these three components of reality essentially define human experience. Now, I'm not talking about right or wrong, I'm just talking about reality. And by that I mean your very thoughts are real, your emotions are real, and of course the fact that your physical is real. What you do is real. Not talking right or wrong, I'm talking real. Now what's interesting, and remember my point, you can know that emotions, psychology, overconfidence in personal opinion, and even our brains themselves frequently influence our decision making, financial and otherwise. It's important to note that whenever our experience is stimulated from something outside of ourselves, so we've got some outside stimulation, it will always stimulate us emotionally first. Many of you have probably heard of the discipline emotional intelligence. Important to note that our emotional intelligence sacrifices accuracy for speed. And by that I mean it's very, very fast, but it is frequently wrong. And you can know that, and you should know that. So when the outside stimulation is such that it scares us, market volatility sometimes can be frightening, unless it's going up every day, in which case it's very exciting. And many of us have experienced both. We remember Alan Greenspan in 1996, November, actually saying irrational exuberance, describing the behavior of investors because of what was going on out here. We had a new economy, we had the dot-com era, we had all that excitement, and it made people feel exuberant. What Greenspan didn't know then, that we know now, is that the emotion exuberance itself can stimulate this sense of irrationality, if you will. It can lead us to making poor decisions. And as the years went on in the 90s, of course, his statement didn't change the market, didn't cause anybody to change their behavior. The market kept going up as people continued to invest in it. Sometimes the stimulations are things that scare us. So we get headlines that say things like, things are terrible, but they're going to get worse. We turn on the radio or the TV, we pick up our favorite periodical, and that message gets reinforced over and over again, whether it's a global credit crisis, a domestic crisis, whatever it happens to be. Now, when it comes to our brain, remember neuroscience, it's important to understand that humans are hardwired on one end to detect and avoid danger, and on the other end to perceive and pursue opportunity. That hardwiring is triggered by something happening out here that triggers us emotionally. And so if we feel fear or anger, those might be danger signals. If we feel excitement or exuberance, those might be opportunity signals. Now, interestingly, when we are either really excited or we're really scared, chemical activity within the brain actually makes it hard to think. So we sometimes don't think clearly. You may have heard someone say, maybe you even said this yourself, I was so angry I couldn't think straight. Or I was so excited I just didn't think I could lose. Whatever. But those are driven by emotion. So on one end, the danger end, we have stress hormones, cortisol. On the other end, we've got excitement hormones, if you will, or dopamine, the chemical dopamine, which actually stimulates this sense of go-for-itness and disables our ability to assess risk, and that's an important thing to know. So you can know that, you should know that.